Hi, everyone, and welcome to A New Economic Order. This is part 2 of a 2-week webinar series exploring the effects of COVID-19 on financial markets and the future of digital assets. This 1-hour live webinar is brought to you in joint collaboration between crypto market data and index provider CryptoCompare, crypto brokerage and exchange BEQUANT, and media website CoinTelegraph. If you have any questions for the panelists, please use the Q&A feature, and we'll be monitoring them throughout the stream and leave the last 15 or 20 minutes for Q&A. Without anything further, I'd like to introduce our moderator, Greg Winterton, who is the managing editor at AlphaWeek, a digital magazine covering alternative investments. Greg, I'll hand things over to you.
Great, thanks, Alyssa. Good morning, good afternoon, or good evening, everyone, depending on part of the world you're joining us from today. My name is Greg Winterton. I'll be moderating today's webinar. During the next hour, we'll be touching on 5 topics relating to the digital assets industry, including banking, Bitcoin as a safe haven asset, security and infrastructure issues and developments in cryptocurrency trading, the institutional adoption of digital asset investing, and the future of digital assets in the financial sector. To answer these most pressing of questions, we have for you today, in alphabetical order by last name, Jeff Dorman, Chief Investment Officer and Partner at Arca, a Los Angeles-based innovative digital asset investment company that blends traditional finance with cutting-edge blockchain technology. Arca Fund's flagship hedge fund strategy, the Arca Digital Assets Fund, is a liquid, long-biased special situations fund designed to give investors access to the best digital asset opportunities. James Harris. James is Commercial Director at CryptoCompare, the global leader in digital asset data. Haydn Jones. Haydn is Director and Senior Blockchain Specialist at PwC. Haydn has over 20 years commercial, operational, and transformational experience working for retail and investment banks, a central bank, a regulator, a global management consulting firm, and a Japanese technology company. He's run cash management and funding units, as well as foreign exchange and equities settlement teams, alongside leading projects to re-engineer the underlying platforms. Dr. Ruth Wandhöfer. Ruth is a partner at venture capital firm Gauss Ventures, and she is also a board non-executive director and an advisor. And last but not least, George Zarya. George is founder and CEO of BEQUANT Group, a provider of exchange, custodian, and prime brokerage services tailored to the institutional community in the digital asset space. So quick housekeeping notes, as Alyssa mentioned, we'll be doing questions at the end, so please submit your questions via the Q&A facility. We'll try and get to as many as we can. To all of our speakers, thank you for taking the time to join us today, and we have much to discuss, so let's get to it, and we're going to begin with banking. So on Thursday, June 4th, the US Office of the Comptroller of the Currency published an advance notice of proposed rulemaking, seeking comment on rules on national banks and federal savings associations' digital activities. The notice asks for public comments about, amongst other things, what activities related to cryptocurrencies or crypto assets that financial services companies or bank customers are engaged in, and what the barriers or obstacles to further adoption of crypto-related activities are in the banking industry. So what are these barriers or obstacles currently, and how will the blockchain impact banking as a result of any structural changes to the global economy as we emerge from the lockdowns imposed around the world? Ruth Wandhöfer of Gauss Ventures, let's begin with you, please.
Thanks a lot, Greg, and hello, everyone. Yes, I think this was a very interesting move because the US regulators have, of course, been quite ahead of the game in some federal states around the licensing, for example, of blockchain and Bitcoin exchanges. But here it's really about addressing the banks. And what the banks have been, to a certain extent, hiding behind for a while was the lack of regulatory regimes that give them certainty that they can operate with certain operators. We've seen this, of course, in Europe and in other markets, that many banks have refrained from opening accounts for crypto firms, whether these crypto firms are performing crypto exchange functions, trading functions, or even if these are crypto firms that are actually providing specific services in the ecosystem, such as anti-money laundering monitoring, which we'll go into later. So I think there's one level around regulatory coherence and regulatory regimes being in place, for example, around money laundering, which of course should be a global harmonized approach. And I'm sure that some banks may respond along those lines. there's certainly also that sort of next level, as you touched upon, around blockchain. So the OCC Advanced Notice of Proposed Rulemaking, which I read through in detail, you would enjoy to hear, also talks about distributed ledger technology and how is this potentially used in banking, and is there a question around whether the regulatory regime may prohibit certain technologies or whether it's too unclear of how to use it. And we all know that DLT, AI, and Internet of Things are also somehow connected. So it's interesting to see maybe in the counterpart here in Europe that the European Commission's Blockchain Observatory has just very recently issued a report exactly around how Internet of Things, AI, and blockchain are connected. And this is, for example, going to inform the European regulator as to how they should potentially proactively encourage certain technology adoptions, and how they could also help on the other side by licensing different actors in the market. I think it will be interesting to see as to whether there will be structural changes to the global economy. Certainly the emerging launch of central bank digital currency, which we know is being tested in China, but also very interesting and advanced topics in other markets, could actually bring structural changes. But if I just look at the digital ecosystem and how that is evolving, we of course start to see that apart from digital exchanges that deal in cryptocurrencies, we also now have the arrival of licensed digital asset exchanges that trade other types of digital assets. We had, of course, digital custodians, which we'll talk about later, post-trade, CSDs. So we're starting to see more and more actors in that space. And again, that may require more specific regulatory intervention as opposed to just an interpretation of existing rules, insofar as these actors operate a slightly different business model, and insofar as the technology may actually allow them to do different things compared to existing laws we have in place.
Very interesting. Haydn Jones, PwC, any comments from you?
So a very interesting question, and thank you, Greg, for that, handing over that to me. So let's unpack some of those structural changes that we think that's going to happen. So if we think about it in a supply chain context, my sense is that what we'll see is a kind of is a rebalancing of trade. So whereas before we've gone to low-cost countries to seek out low price points, what we've seen now is the sort of the understanding that actually some of these points of supply in the supply chain are highly, we become highly dependent upon them as far as things like PPE are concerned. I think what we'll see is a repatriation of the provision of some of these goods and services back to some of our local economies as we had them before. So that then implies this kind of rebalance of trade. If we then think about what's got to happen in terms of de-risking the supply chain and actually increasing resilience in there, that goes to things like trade finance and whether we can actually put trade finance onto distributed ledger technology, which I know we can. There are products out there that do that, such as R3. They're certainly very much in that space. But also, this idea of de-risking in the supply chain, it's very much around improving transparency, understanding where the stress points are, and actually making sure that suppliers get paid on time, because that's what's really sort of punishing some of these suppliers, because we've got invoices that are ending up in accounts payable departments, and they're not getting addressed because people aren't coming into the office. So I can see the emergence of groups of DLT blockchain-based products that will support and address some of these risk factors within the supply chain. So the question is, how do the banks deal with those? How do the regulators deal with those? Because they're going to be multi-jurisdictional. They're going to cut across different tiers in the supply chain. And I think Ruth touched on there's kind of the lack of a regulatory backdrop, which is incredibly important. So the question is, who's going to go first and create that regulatory environment? We also have, a complex ecosystem of all sorts of different stakeholders that cut across the supply chain that are going to need to be managed, and that faces off into the complexity, the inherent complexity within the banks. So we have new products to de-risk supply chain. We've got groups of stakeholders that are going to manage and adopt those products. We've got the need for a regulatory environment. And I think Ruth touched on central bank digital currencies. That potentially could actually underpin this. We see the emergence of that in China, certainly, and there's work underway in the United Kingdom, the Bank of England, and they're already looking at that as well. So I think that a kind of a vanguard push to help us rebalance trade through the use of distributed ledger technology, through new forms of products, could be triggered by something like a central bank digital currency, which in turn will need to have a suitable backdrop in terms of providing confidence to people in the way that they can step forward and actually adopt its utilization.
Terrific. And do we have any other comments from James, George, or Jeff on this one? I mean, we could spend half an hour on this one, but
I did wanted to add a point from a practitioner standpoint, and speaking from the professional trading community perspective. One thing about the banking and how the blockchain is being adopted within this growing industry of traders of digital assets, we've seen an explosive growth in the stablecoins market, which tells us that the banking system is not really coping well, and the usage of stablecoins is so much more convenient and efficient from many different angles for traders. And I think that's an important factor to put on the table. I mean, we've seen a number of exceptions here. I can say that as far as the U.S. trading community in particular, there's a couple of banks in particular that have centralized trading and clearing, the Silvergate and Signature banks, that you hear pretty much every day when we talk to our clients. These two names essentially consolidate majority of clearing of any trades versus fiat. But the largest chunk is still being traded through stable coins, and it continues to grow. And yeah, I think that's all I want to say.
Yes, thanks, George. And again, we could spend half an hour on this one, but we've got a lot to cover. So let's move to a bit of a more punchy topic, which is Bitcoin as a safe haven asset. In a recent leaked presentation, which was all over Reddit and Twitter, Goldman Sachs recently said about Bitcoin that we believe that a security whose appreciation is primarily dependent on whether someone else is willing to pay a higher price for it is not a suitable investment for our clients. However, influential hedge fund manager Tudor Jones revealed recently in an interview with CNBC that he has an allocation to Bitcoin, saying that every day that goes by that Bitcoin survives, the trust in it will go up. So who is right and why? Jeff Dorman of Arca, let's start with you, please.
Sure, thanks, Greg. I actually think those are two separate questions, and I want to address them separately for a reason. So the first one is whether or not Bitcoin is a safe haven. And I certainly encourage everybody to read the investor letter that Tudor Jones put out, because it's probably the best explanation for why somebody should want to own Bitcoin that I've ever read. And it wasn't that he was a diehard Bitcoin maximalist. It wasn't that he was 100% certain that Bitcoin was the future. It was really just a probabilistic weighted analysis that if you have all of these things that will work under inflationary environments, whether that's real estate or hard assets, or that's equities, or that's gold, if Bitcoin has even a small percentage of a chance, the market value of Bitcoin is way too small relative to these other asset classes. And from a probability standpoint, you should own some of it. So it was a really interesting argument. And it goes back to the idea of whether or not a safe haven and flight to quality are the same thing. So a lot of people think Bitcoin should always go up when the equities go down, or should always go up when gold goes up because it's a flight to quality asset. And as we saw in March, that's not the case. Bitcoin is still a risky asset, and in any near term or short period of time, it could certainly behave like a risky asset and therefore not a flight to quality. But that's very different than a safe haven asset. A safe haven asset literally means you're seeking refuge, or you're getting away from something. And over longer periods of time, maybe this is years, maybe this is even decades, I think Bitcoin really can be a safe haven for any individuals who have money in countries where they don't have control of their own currency, or they are have a very hyperinflationary or depreciating asset. Having some safety in the sense that your money cannot be taken away from you and cannot be depreciated away from you can be a safe haven, even if it never acts as a flight to quality. Now, on the flip side, I think the other question is much different, which is why is Goldman saying that something that other people pay for is the only reason it has value? And to me, this is one of the most ridiculous arguments I've ever heard for any asset, because if you look at every single asset in the world, that's exactly what you're doing. Take the PE ratio, for instance, in stocks. I mean, what does a price to earnings ratio mean? It means this is the price above the actual earnings potential that somebody is willing to pay for it. Take a look at high yield bonds. Almost every high yield bond is issued by a company that has no chance of ever repaying that debt, but because they believe that somebody might refinance that debt when it comes due with new debt, therefore that debt has value.
That's terrific. Thanks, Jeff.
What an asset is really worth it. Oh, sorry. The idea of an intrinsic value, or the intrinsic value of an asset, what an asset is today, is often very different from where it actually trades. And we can look no further to what the Federal Reserve just did. The Federal Reserve literally came out with a statement and said, we're going to buy ETFs and debt because by announcing this facility and including companies who can't actually do it themselves, we're going to allow companies to stay in business. So effectively, the government is now saying we're going to pay more for things than other people are willing to pay in order to keep the economy going. So pretty much everything Goldman said in that argument can be invalidated about Bitcoin, but more importantly, is true of every other asset as well.
Terrific. Thanks, Jeff, and also thanks for deconstructing that quite nicely into two different parts. James Harris of CryptoCompare, your thoughts there, please.
Thank you, Greg. And Jeff, I'll give you this. You're a tough act to follow. The Goldman Sachs client call that was leaked was really caused quite a stir in the crypto sphere. I mean, my Twitter was on fire and people from every side of the spectrum weighing in with their 2 cents. But as Jeff said, really, you can look at it in a cynical way, perhaps. This report was written by 2 senior, well-regarded economists, not the summer intern, as some Twitter wags would have you believe. I mean, John Hatzius has been around since time immemorial and is a proper name in the economist world. And the second thing to know is that this was a client call, right? So recommending BTC as an asset class does absolutely nothing for Goldman Sachs. No trading, no custody, no fees, nothing at all, right? So the quote is funny in the end, as Jeff said. Goldman Sachs makes a living precisely of telling their clients and then to sell on at a high price. So maybe you should look at this report and say, this isn't perhaps the best source of truth for Bitcoin. Whereas Paul Tudor Jones has fashioned a career from taking big, ballsy macro bets early on before everyone else gets on a certain trade. So he's actually putting his money and his clients' money on the line. And if he says that Bitcoin might be the best inflation hedge out there, then perhaps it's worth listening to. I echo Jeff's thoughts. The piece is really worth reading. And so if you can, it's all over the internet, but we can send it to you for anyone who's interested. Do have a read. But the question of BTC being a safe haven is probably either immature or looking at it slightly the wrong way. To become a safe haven takes time. When you think of a safe haven, there's 3 that immediately jump to mind. You've got gold, you've got the yen, and you've got treasuries. And these are safe havens for different reasons. Because it's store value for 5,000 years. So when things get tricky, people buy gold. It's in people's DNA. The yen's an interesting one. The yen rallies because when in volatile markets, Japanese corporates and investors sell overseas investments and bring money back home. This creates a yen bid, so it goes up. Now treasuries are safe because people believe that the US will repay their debts. So this then, every time there's volatility, these havens tend to rise. This creates muscle memory in traders so that when they see volatility, they then buy these havens. Now, Bitcoin's only been around for 10 minutes, figuratively speaking, but 11 years in real terms. And that muscle memory isn't there yet, but it's coming. Now, BTC sold off 50% in March. And you know what? It worked. It allowed risk transfer. The markets didn't seize up. People sold, they raised their assets. It was a dash for cash. BTC function. But then it rebounded hardest and first. It was the first to make new all-time highs. NASDAQ made it the other day, a little less today. But moments like that, periods of time like this, start building muscle memory. And traders will remember that, hey, wait a minute, this thing actually has got some legs as a haven. It's going to take time. We started seeing little hints of it acting like a haven last year when the geopolitical stuff was breaking out in the Middle East and in China. So when people do start seeing it like a safe haven, it's going to start taking market share from these other havens. And the first one it will take market share from is gold. Now, the real question perhaps is BTC a hedge from the macroeconomic situation that we find ourselves in with unhinged monetary stimulus, fiscal stimulus, and monetary printing? Well, I'll leave that one to Paul Tudor Jones. He says it's the fastest horse in the race. I totally agree.
Outstanding. Ruth, George, Haydn, anything to add?
I think just a headline is a safe haven from what? And the world is faced with all sorts of vicissitudes. I'd argue in some ways that we're kind of lucky to have something which is new and different and novel, which is very different from the traditional form of money. I mean, money's been around for 4,000 or 5,000 years. We used to barter, we used to collect pebbles. So the concept of money has changed. So the fact that we've actually got something which is very different, I think is really quite compelling, and it sits there. And I think it was Jeff that said, it stops, a haven stops value from being taken away from you. So what is the threat that's being posed? So those threats may not be apparent currently, but at some future point they may be very apparent, and something like Bitcoin could be very attractive. So I think we should be, it's out there as an instrument, as a product. We should look at it carefully.
Yeah, maybe just to add a geopolitical question as opposed to a pure financial asset return question.
Yeah, it's interesting. I mean, I guess certainly whether you're a Bitcoin bull or a Bitcoin bear, there's never a dull moment, and it'll be interesting to watch this develop over the coming months and years. Moving on to security and infrastructure issues in cryptocurrency investing, digital asset exchange hacking and the risk of loss of digital assets in cold storage have generated significant media, coverage. So let's talk about some of the best practices that investors, both individual and institutional, should be considering when sort of trading themselves or allocating capital to a third-party digital asset investment manager. And what are some of the developments in the industry that are happening now that should help mitigate the current risks in the next 12, 24 months? George, Zarya of BEQUANT, let's start with you for this one, please.
Yeah, well, I'll start with the sort of a retail angle first, right? So what we have seen in abundance is the multiple hacks of I mean, there's lots amounts of fraud and happening using cryptocurrency. That's kind of puts a lot of negativity onto the industry in general, and it's a lot of it stems from the basic common sense knowledge and the basic security policies, procedures that one have to use when operating with digital assets. When owning the money, right, by not putting it with the bank, you're assuming a full responsibility for it. But that again puts a lot of fraudsters onto the sort of a challenge of tricking people into giving up that asset. And here what we've seen is there's been a huge number of frauds, and I think the fraud is by far more dangerous than cybersecurity issues of a particular exchange, because we know that a lot of the exchange hacks that happened before, they were initiated or stemmed from the inside of the organization, with somebody from the inside leaked certain information. And again, the way we see the industry is evolving is by learning from the mistakes. And I mean, the one technological enhancement that we've seen happening over the past couple of years was a very simple one: installing two-factor authorization and make it compulsory for all of your clients. That's what the exchanges are typically now adopting to protect, first of all, to protect retail funds, and it works. I mean, we can spend hours talking about how the institutional custody space has been evolving, and obviously there has been a very huge learning curve and from the technology perspective, and from the breaking down multiple sub parts of the infrastructure of how to secure the assets of or sort of a larger institutional client base. And there's been multi-MPC concepts that allow to sort of eliminate owning the keys by people. There's the HSO, sort of a hardware related type of implementations within the custodians. There are insurers that become more knowledgeable about how to secure the assets and what risks are to be mindful of. So all these processes combined lead us to a pretty secure place in terms of like what the infrastructure is available in terms of safekeeping the digital assets. And we've seen a number of large custodians in the space managing billions of assets in their custody, and we've seen that these cold storage providers have not had any issues so far. We've seen a number of hacks like Binance, for example, last year. These kind of cases, again, they are becoming more and more rare. And I would say that the one thing that the industry needs to be aware and be and sort of raise the education level is on the fraud. I mean, the amount of online fraud is extreme at the moment, and everyone is being targeted every day by. So you just have to be aware, and that's the rule for safekeeping the assets.
Terrific. Haydn Jones, PwC. Anything to add?
I think that the relative ease with which you can set up an entity that looks like some kind of crypto entity, it's straightforward. I mean, one of my companies has been the victim of a scam whereby they borrowed an identity associated with me and attached me to another entity, which was tricky, and it's embarrassing, and it takes some time to kind of unpick that. And I think it echoes George's point, because that's a relatively easy thing to do. A lot of information about individuals is publicly available, and it's very easy to create what look like sort of, strong, legally accredited entities in some form. They're registered properly, where in actual fact you step behind them and you discover it's a sham. So the internet and visual websites and all this kind of stuff make the ability to tell the story quite easy. The key test has got to be around the key hygiene. So to control a digital asset, you need a public and a private key. The public key is the address where the asset sits on the ledger. The private key is something that the manager, the asset manager, the custodian, the exchange has control of. And I think the key piece of due diligence to do is, one, look at key hygiene. The way those keys are held will be from a range of hot storage all the way through to cold storage. Cold storage implies that it's held offline, so it's not connected electronically to anything. And then I think the second key test alongside that is, what's the nature of any insurance policy that sits around key storage, which is a key question. You ask that question, very quickly you'll get to the bottom of the hygiene associated with that entity. Because to insure the keys, the insurers, and there are products out there now for cold storage, to insure the keys, they will have to do the due diligence anyway. So they're actually doing your work for you. So ask the question, are your cold storage facilities insured in any way?
Terrific. Ruth Wandhöfer, any comments from you?
Yeah, I mean, if we flip it around to the other side, so there's a lot of fraud, and I think we also now have organizations out there that can help to retrieve stolen Bitcoins. I mean, George mentioned the Binance hack, and one of the providers in the market had actually identified the exact address where that hacked money went to. And of course, if someone wants to take it out, it's quite tricky because you start to see the account on the ledger. And I think I'd like to also just mention, again, with the growth of the ecosystem and the importance of filling all of those securities and regulatory gaps, because anti-money laundering rules are applying in more and more jurisdictions. And we also now have the FATF travel rule that applies to all virtual asset providers and the transfers they're undertaking. We will inevitably see more services emerging in this market. So it's about the ecosystem growing with service providers that do anti-money laundering monitoring, risk assessments such as CoinFirm or Chainalysis. Those providers will grow, and we will also, on the flip side, start to see supervisors using those providers to actually enforce monitoring on those new subjects in the value chain, such as crypto exchanges and wallet providers that are today, for example, in the European Union, subject to Anti-Money Laundering Directive 5. So it's a growing ecosystem, and it's becoming more secure through technology solutions as much as the regulatory and supervisory framework that goes across it.
Terrific. Jeff, James, any comments from you guys?
Yeah, I mean, I think one thing that we hear over and over again is, well, Bitcoin can be hacked or digital assets can be hacked. And that's, that's like saying that if a bank was robbed, the US dollar was hacked. So I just want to make it very clear that the structure of these digital assets themselves is not the issue. Where these digital assets are being housed, where they're being traded, is generally the point of weakness that is being exposed. At Arca, we have a full-time employee who has 25 years of operations experience across debt, equities, digital assets. He works harder than anyone in our firm. We probably do more research on service providers and counterparties than we do on the investments that actually go into our fund. Because it doesn't really matter how good our returns are. If we can't pass operational due diligence, we're never going to have any money in our fund anyway. So, there is a lot of work that goes into researching and due diligencing all of the players in this space. And yes, because it's a new space, there's certainly some bad actors as well. But just like anything, if you do your research and or you hire a manager or somebody who, as a professional who has done the research for you, almost everything that is a problem in this industry can be avoided at this point.
Terrific. Thanks, Jeff. We'll move on to the fourth topic now, which is the institutional adoption of digital asset investing. Many large institutional investors like public pension funds in the States can't invest in cryptocurrency offerings because of many reasons, but including capacity issues and volatility. So what needs to happen, and many more. So what needs to happen in order for cryptocurrency asset investing to take more of a share of investors' overall portfolios? And when will that happen? Will there be one or two significant catalysts, or will it be a case of slow and steady wins the race? And then on the VC side, perhaps VCs have had more luck in securing institutional dollars, but does blockchain investing need a unicorn IPO to prove the opportunity to investors or not? Ruth Wandhöfer, let's start with you on the VC side, please.
Yes, thanks, Greg. So we've seen increasingly VC funds, small and large, specializing in the area of blockchain, which can even reflect specific segments of the market. It could be, as we mentioned earlier, with Haydn, trade finance, blockchain investments, and the ecosystem around that. It could be the sort of capital markets of the future, which allows for cryptocurrency trading as much as any other digital asset trading. And so that expertise is developing, and there's a lot of existing knowledge from ecosystems such security, clearing and settlement, payments and trade that comes into the investment focus on that side, combined with the new technologies to create that. I do think we're starting to see some emerging companies that are really getting bigger and bigger. I mean, we have even token compliance companies that are valued quite significantly in the US. Again, one of the small niche segments of that ecosystem value chain. But, of course, more unicorns might help. But I think it's much more about understanding that this digital asset ecosystem is now accelerated in its development also through the crisis, because everything is digitizing. And I think that interest also from family offices and other sort of high net worth individuals to engage with VC funds in that particular area is something that we start seeing to increase as well. So I think we're not at an early beginning. We even obviously have Horowitz focusing on crypto funds and the ecosystem around that. And I think we will see more of this as the infrastructures are being built.
Terrific. Jeff, let's go to you next. I think you guys do a bit of venture investing perhaps as well. So if I'm right, feel free to talk to that. But of course, on the hedge fund side, be grateful to get your comments here.
Sure. Well, I mean, I'll start with, we have 12,000 institutional investors on our distribution list at Arca, and we get sometimes 70, 80% open rates on the educational content and the crypto market recaps that we put out. So for anyone to say that the institutions aren't here, they may not be investing yet, but they are very engaged. They are paying attention. They are trying to learn this space very fast. With regard to where the money has flown in thus far, it's really flown into two places. The first is it's flown into the equity of picks and shovels companies, which makes sense because you have to set the infrastructure for a new industry before you can really get excited about the assets in that industry, right? That's why you have some unicorns right now, exchanges like Coinbase, or even data providers. You know, that's where the money has flown in yet, because that's an easy investment, right? You're basically just backing early stage companies. Along those same lines, money has flown into venture funds, because really that's not a departure at all from what institutional allocators have already been doing, right? They already have a sleeve of alternative assets, which includes venture investing. It doesn't really matter to them whether that venture investment is in a digital asset company, or it's in a biotech company, or it's a defense company. The investing mandate is the same. You're investing in the equity of early stage companies. So that was by far the lowest hanging fruit. To get these investors now to buy Bitcoin directly, or to invest in a digital assets fund like what we run at Arca, or to do other strategies within the space, it's very similar to anything else, which is like, nobody wants to be first, nobody wants to be last. So Paul Tudor Jones really just, not only was it a great thesis that he had on Bitcoin, but he basically just told every other macro hedge fund manager that, hey, it's okay to get in the water because we're doing it. That same thing is going to happen with pensions and endowments and sovereign wealth funds. Eventually someone's going to say, we're doing this, and everyone else is going to follow. I think part of the issue right now is just a lack of institutional available products to buy. I mean, this is still a small asset class. Most of the allocators are bigger than the asset class itself. It's very difficult to find something to buy. You could buy Bitcoin, obviously, but there's not a lot of other products yet that are attractive. So I think the product set has to grow. And also, I mean, like I used to run a credit opportunity fund where it would take allocators 2 to 3 years sometimes to allocate. And that's when they already knew us. They already knew the fixed income industry. They already knew all of the other players. They already knew all of the other service providers. And it still could take 2 years to do due diligence. So to think that these allocators are going to work quickly when it's an entirely new industry, entirely new asset managers, entirely new service providers, it's just not very practical. So, it's not that they're not here, it's that they're doing what they do, which is evaluate, take their time, do due diligence, and try to figure out where this fits within their mandate in the buckets that they have allocations to.
Terrific. James Harris, CryptoCompare. Any thoughts from you?
Thank you, Greg. Yes. So thanks again, Jeff, for throwing me into a hole. But I think one of the points he made about products, institutional grade products that are easy to invest in, that abstract away some of the difficulties that the panelists have talked about, owning. I believe we might be tackling that in the final question, Greg, so I'll leave that one for that. I saw an astounding stat today by Fidelity Digital Asset Markets saying that 36% of their institutional base that they polled had either directly or indirectly an investment in digital assets like Bitcoin. I was staggered. And we are at CryptoCompare, the leading digital asset market data company. We're very much, we believe that we're the canaries in the coal mine. The first thing that firms do when they're looking at assets is buy market data, see what the exchange, what the exchange ecosystem looks like, understand the assets themselves. I mean, we track 3,000 plus digital assets. Do I know all of them? Absolutely not. Do I care about the top 20? Probably that's about right. We track 250 exchanges. And we look at these exchanges and we look at, we try to create a safe place for to understand the ecosystem. So we rank our exchange partners on a whole range of quantitative and qualitative factors. And we release a quarterly or half-yearly benchmark report that really helps our clients and institutions understand which exchanges are worthy and which exchanges they can actually transact on, i.e. a safe place to do business. And what we're finding is that the ecosystem is improving at an incredible pace. There are 20 or 30 truly excellent exchanges with great governance, with great oversight, trade monitoring, all the things that you'd expect from a traditional exchange that we track, that are safe places for firms to do business. And then the next thing that they probably need is they need to understand that the market is much bigger than than they believe it is. So just this last month in the, our review of the exchange volumes, spot and derivative markets in May, in 1 month. I mean, these are big numbers. These aren't markets that you can ignore much longer. Now, you might say, well, okay, they're all punters, but actually this is not true. The CME, which is institutions only, did a record $7 billion worth of volume last month on their derivative platform. So institutions aren't just coming, they're here. That's the important takeaway. Do they need a little bit more guidance globally from regulators? Yes. Do they need to feel safer investing? Yes. But to the previous question, these institutions, the custodians, they are institutional grade players with whom you can feel very confident leaving your assets.
Terrific. Ruth, Haydn, anything from you?
I liked Jeff's point around picks and shovel investing, and I'm going to just make reference to his beautiful picture of the Brooklyn Bridge behind him, because what we've seen so far is the sort of, we're digging these nuts and bolts out from the ground, if you like, and we're kind of looking at them, and the nuts and bolts of these interesting digital assets. But where the big money is going to be is when we start actually building big sort of financial bridges, big financial motorways that are sort of connecting large parts of the economy. You look at what Oracle and SAP have achieved, and the global economy is built on Oracle and SAP. Well, think about Oracle and SAP with store of value in there, and legal capability and payments infrastructure, and that's when we really begin to transform the economy. I shouldn't have gone first. I should have asked Ruth to go first, but I was just kind of blown away by that picture of the Brooklyn Bridge.
No worries.
I may add as well. There's one other sort of a trend that we've seen over the last couple of years is, and the tokenization of securities has been a buzzword in certain circles, and I think that's one of the ways of where the blockchain technology may get expedited adoption is by placing securities into a tokenized form, and then we can see the emergence of the digital assets like Bitcoin and the altcoins mixing up together with the stocks and bonds and commodities in a tokenized form. And again, the technology is brilliant to minimize cost, to achieve straight through processing and eliminate lots of costs. I think that's the future of digital assets in particular, is adopting and embracing the technology benefits. That's how it all started.
Yeah, maybe just to add, I mean, it's all about creating the picks and shovels for the whole system. And my vision is also that the existing financial market has to reinvent itself to make itself efficient based on these new technologies. And we're clearly a long way from there. But that's why I find it quite exciting to invest in companies that are creating that infrastructure and that are allowing existing regulated assets to be traded in different ways. And they're allowing a lot more value to be created, not only through speed, but also fractionalization, inclusion of other assets. And I completely also echo, of course, Jeff's point on we need a lot more products and regulated products where the end sort of, the wealth funds and particularly the pension funds are comfortable to invest in larger amounts in terms of the regulated limits and rules they have to follow.
Terrific, thanks Ruth. So we'll move on to our last topic of the day before we go to any questions, which is the future of digital assets in the financial sector. George, a brief comment from you just a couple of minutes ago segues nicely into this one, and we'll have you go first. What are some of the areas of finance where blockchain is truly making progress? Is the innovation coming from startups which have the focus and the hustle, or from larger organizations with more resources? And how is that impacting the growth and adoption of digital asset technologies in finance?
Yeah, well, it's to add to the point that I've already done is basically the operational efficiencies that could be achieved by adopting blockchain into the mainstream, into the operational cycle, are enormous. And again, I've spent over a dozen years in prime brokerage electronic trading on the traditional finance side, and I recall having the armies of operations people and a handful of IT guys sitting in the corner, and now the situation is absolutely reversed. I mean, you have we have an army of IT and zero operations, which means that every process is being streamlined and automated. and that translates into the efficiencies, into the cost that it can be passed on to the end user and customer. And that's how I believe that all of the financial institutions need to look into the technology, how it can be adopted, and into the middle back office, into clearing ecosystem, into the we've touched upon the central bank digital currencies. I mean, there are examples of how things are being already addressed, and I believe that this evolutionary cycle will definitely involve more and more blockchain tech. In terms of like how this innovation is being brought to the masses, it's clearly within the startups. I mean, the startups are by default are much more prone to innovation, with less bureaucracy and less hoops to jump through. So that's where the industry and the barrier to entry into the blockchain tech is so by far less than any other businesses in the financial sector, which are regulated and require lots of capital. You can now operate a digital crypto exchange by white labeling the technology within a couple of weeks' time, right? So we've had a number of JVs with the retail brands, and this is we've gone through these cycles, and we understand that the owning your business and operating a complex technology sets is becoming so much more easier due to the benefits of the tech. But I do hope that the larger institutions with the balance sheet will follow through, can expedite the growth in these innovative areas, and help these businesses to become unicorn size and scale up through the masses.
Fantastic, thanks, George. James Harris, CryptoCompare. I think you had some interesting thoughts here.
Yeah, I mean, the trends in tokenization and decentralized finance, they're really undeniable. And the ecosystem is getting complex quite quickly, and I'm a huge fan of that. But I actually think that a lot still has to be done on the basic level. We touched on in the previous question that there aren't institutional grade products out there that are super accessible. The US, for instance, still doesn't have an exchange traded fund for Bitcoin. It keeps getting knocked back by the regulator, but eventually it will come through. What the US does have is it has a few OTC traded trust products which are doing very, very well. Grayscale has one that has $2.7 billion, something like that, for Bitcoin, which is the behemoth at the moment. But it's a pretty inefficient way of doing it, OTC pink sheet style. And what we really need is a simple exchange traded fund. So the meme of when ETF is getting tiresome, but I think it will happen soon. Now, we recently helped one of our clients, 3iQ, launch one in Canada. So it was the first North American ETF, and actually they're going great guns. So we're very pleased with them. And we do that in conjunction with a company called Envis, which is a subsidiary of VanEck. And together we create and distribute reference price products against which financial service providers can create investable products. And so that's really interesting. That's but believe me, these are the kind of things that will help adoption. And if you look at the market overall, these ETPs and ETFs are actually only about $3 to $4 billion in size. We expect this to 10x over the next 5 years. So exciting times ahead.
Outstanding. Jeff Dorman, Arca. Any thoughts from you on this?
I think my base case is that the digital assets that exist today, a lot of them are very exciting, but most of them are probably not. But the amount of assets out there that can be tokenized introduces an enormous new wave of investing potential and growth potential. So you're already seeing little snippets of it beyond just Bitcoin, and I think that's really where it's more interesting to me than just the other investment products itself. So, for instance, some real companies like Atari and Reddit are now coming out with tokens. You're seeing there's an NBA player, Spencer Dinwiddie, who is tokenizing his salary. At Arca, we're actually working right now on products where you can tokenize bond and equity offerings. So, while Bitcoin is great, and we've discussed all the reasons Bitcoin is great, and then actually there's a whole a universe of digital assets below Bitcoin that do a variety of different things that are also great. I really think the explosion of the digital assets itself as a technology and all the different assets that it's going to support is really where the growth is going to be. Like, I would not be surprised to see digital assets be a part of every company's capital structure in the future, right? You have your equity, which is a claim on cash flows. You have your debt, which is a claim on assets. And then you're going to have your tokens, which is a claim on future services or, network growth. Like, Starbucks will probably have a digital asset at some point, which takes advantage of their massive network and all the different events and things that they do that are related to Starbucks. And that'll effectively just be a revenue line item for Starbucks, right? They're selling forward future services in the same way that like a gift card works. So I just think there, when we talk about investable products and tokenized assets, I just think there's going to be an explosion over the next 3 to 5 years of different areas where people can invest in. And it's not going to just be technology-minded people who understand decentralization and money. It's going to be, regular everyday investors who don't even realize that the underlying token is what they're investing in. All they care about is the asset that it represents.
Yeah, and I think that digital fiat currencies are closer than people think. We strongly believe that China is going to quickly bring out a digital yuan, and there was a recent test in Europe as well for a European country's digital. That was the euro. So. Will be the thing that will expedite everybody's need to have these assets on their watch list. So we will see. The other thing to note is that China will be looking to try and create something to counterweight the USD. It will be a way of trying to gain some market share on the global level.
Greg, maybe chime in. I see indeed the future of almost every asset becoming digital, but also fiat currency becoming digital, because you need that as a settlement item. And I think that's where stable coins become actually sovereign issued sort of stable coins, if you so wish. I think it's a question around terminology, but I think that is another piece that was missing so far, which is why we've seen such a growth in different stable coins. Also because it was difficult for people to deal with the fiat and exchanges and their bank relationships. In future, as everything moves digital, we will have a nice sort of atomic settlement across digital assets and digital fiat, and potentially also quite significant implications for how foreign exchange markets operate and the efficiency that can be gained through more real-time exchange rates, and also probably taking out quite a few of the middlemen that have so far taken cuts based on information asymmetries.
Okay, I go, Greg.
Please, Haydn.
Okay, so, and I'm gonna look at this in a slightly different dimension, because the question is the future of digital assets. That's a really big question. So let's kind of just step out of that for a moment and just kind of borrow some ideas from a very important adjacent technology, which is radio. So Marconi invented radio. Before Marconi, we used to transmit data over copper wire. And what Marconi managed to do was to get rid of the copper wire, which is a pretty magical thing to do. When you think about it, that's what, about 120 years ago, thereabouts. And today we sit here and we all communicate by radio, telecommunications. We've probably got 30 or 40 transmitters, receivers on our person in our rooms, but we don't think about it, okay? Radio is incredibly important. What Marconi did in getting rid of copper wire in terms of reducing economic friction was a hugely transformational step. Now, my prediction is that, we transmit radio through the ether. My prediction is that central bank digital currencies will be the financial ether of the future, because what they give you the ability to do is to connect payment and ledgers, store of value. So we've brought 3 important commercial pillars together, but we can put conditions, we can put contracts on top of that. So we can actually sort of build, the new digital economy on this central bank digital ether, if you like.
Terrific. Thanks, Haydn. There are 5 topics, and it looks like we'd normally go to Q&A now, and we only have sort of 5 minutes left on the call. It looks like we have a quiet audience. So if I may be so bold, I'd like to pose quite a generic question to the panelists, which is that, and we've kind of touched on this very briefly earlier in the call, the current, let's call it, digitization of work, which is happening due to the lockdowns imposed by governments all over the world, is very generic, and people are finding creative ways to work and be productive and all that sort of thing. Could this be a quote unquote eureka moment for the concept of digital in terms of investing, or is it really just something that's obviously very well understood, as Jeff, you kind of alluded to, and all it will do is kind of accelerate any kind of change? I'm pretty sure that's a very loose and generic question, but any comments on that would be most welcome.
I'll start. I think
go on, James Harris, CryptoCompare.
Yeah, thank you. I think that what this lockdown has done has forced people that are very used to doing things face to face to do them online. So the last stalwarts of branch banking, perhaps, are now falling apart. And to Jeff's point, I think that once people start transacting and doing things on platforms, the technology underneath, they don't have to know how it works. And what I think we'll find is that this will hasten the adoption of digital assets as the functional plumbing.
Very interesting.
May add this pandemic crisis have, I think, put the sort of the final nail into the coffin of paper money. It's literally it's really hard to find a place now that will accept bills, and I understand that this may change at some point in time when the pandemic goes away, but it definitely gave another push for digitizing any payments.
Terrific.
I think it's been pretty obvious that the shift to a digital world has been happening before the pandemic hit. This is just accelerating it beyond everyone's dream. I mean, Microsoft, the CEO of Microsoft just a few weeks ago said the company has experienced 2 years of digital transformation in 2 months. They're not alone. Every single company is now figuring that out. Every single individual is now figuring that out. So this is not a new trend. This is just an acceleration of a trend that was happening anyway.
Terrific. We have no more questions on from the audience, so I guess we'll wrap it up there. Thank you very much indeed to our panelists, to James, Haydn, Ruth, Jeff, and George, to CryptoCompare, BEQUANT, and CoinTelegraph for organising this webinar, to you, the attendee, for joining, and we wish all of you a very good the rest of your day. Thanks for having us.